What's up everybody, Gen X Dividend Investor here. In this video I tell you all about the dogs of the Dow, which is an investing strategy invented in 1991 by a successful money manager who claimed that retail investors could beat Wall Street pros 95% of the time by putting their money into out-of-favor dividend stocks in the Dow Jones Index. I'll also share what CFOs around the world think about inflation, the chance for a soft landing, and what they think the markets will do this year. But first I want to recognize all the folks who've joined my channel. Thanks, I really appreciate you guys supporting my goal to help educate the world about investing. Okay, so let's start. The dogs of the Dow is a strategy where you buy the 10 highest yielding dividend stocks in the Dow Jones Index, then hold them for a year and a day to optimize for taxes, and then rebalance your portfolio and continue to do that. They're called dogs because they're probably out of favor with investors, which is why their share price has fallen, which in turn has pushed their yields up. Remember, the formula for dividend yield is dividends paid out in a year divided by share price, so high prices usually mean low yields and low prices often means higher yields. Plus, since Dow stocks are generally considered good companies, then the theory behind the dogs of the Dow is that you're buying quality stocks when they're cheap in hopes that they'll recover, which stocks in the Dow usually do. I found a site called Admiral Markets that charted the performance of the dogs relative to the Dow index itself for the last 10 years, and this is how things looked. So the Dow index is in blue and the dogs are in red, and you can see that their performance is roughly in line. Sometimes the dogs outperformed like in 2013, and sometimes they really outperformed like in 2022. But they also sometimes materially underperformed like in 2020. When I added up the entire performance of the Dow index using the returns listed on that site, I got a 142% return, slightly outperforming the dogs who returned 137%. That doesn't sound too great until you realize that the dividend yield of the dogs is much higher than the Dow index would have given you. So if you were wanting decent stock price appreciation, but with a much greater income, and were okay with slightly lower total returns, then the dogs might have been ideal for you. Like the Dow index currently only has a 1.9% average dividend yield versus the dogs who currently average a 4.2% yield. And note, I'm not talking about the chemicals and plastics company, Dow Incorporated, whose ticker is Dow and is in the Dow Jones, and in fact is one of the dogs of the Dow. Anyway, there is a downside with the dogs that I'll tell you about in a bit. And you need to realize that while historically the dogs performed okay, that doesn't necessarily mean they'll do that going forward. Now, the Dow index is one of the oldest stock market indexes in the world, having been created in 1896. Unlike the S&P 500, which is basically just the 500 largest public companies in the US, the Dow Jones Index is made up of only 30 companies which are handpicked by a committee of people from S&P Global along with the Wall Street Journal, using fairly subjective criteria. They look at market cap, how many shares are being traded, what sector stock is in, etc., and they pull the stocks from the S&P 500 to be included in the Dow Index, but they exclude transportation and utility stocks since those are already covered in other Dow Jones indexes. The Dow Committee tries to include companies with excellent reputations that have demonstrated sustained growth and which they believe are of interest to a larger number of investors, and they make changes to the Dow Index whenever they feel it makes economic sense to do so, rather than change it quarterly or annually or whatever. They stock price weight the Dow rather than market cap weight it, and they don't use a weighted average. So the Dow Index is calculated by adding up the stock prices of its 30 constituent companies, then dividing that number by a divisor, which currently is below 1 and thus technically makes it a multiplier. For Investopedia, the divisor is often changed in response to stock splits, or if a Dow company decides to start or stop paying dividends. So I guess dividends aren't totally irrelevant, are they? Speaking of that, I just got an email that says, dividend payments to shareholders worldwide reached a record $1.66 trillion last year, which is 5.6% higher compared to a year ago. Pessimism over the global economy proved ill-founded in 2023, and although the outlook is uncertain, dividends are well supported. And speaking of irrelevant dividends, here's an article that just came across my feed where an analyst said, the Magnificent Seven may shift their cash return strategies more in favor of dividends as their cash flows become increasingly stable and as the companies seek to expand their investor bases. So again, dividends are clearly not irrelevant. Anyway, back to the topic at hand. I feel like the Dow Jones Index is non-objective and doesn't hold enough companies and is too heavily influenced by human biases, which is kinda a risky thing because getting into the Dow can help boost the stock's price and getting removed from it can hurt it. That being said, the Dow is still one of the most popular indexes people talk about. Like I was reading an article on CNBC today, and it has an excerpt that says, over 80% of CFOs believe the Dow Jones Industrial Average is more likely to continue to run up to the 40,000 point mark, with technology continuing to lead the way among sectors than slip into a bear market. Now take a listen to this 90-second blurb from CNBC on March 13th of 2024, sharing results of a recent survey of over 100 CFOs from around the world.
Attention to the latest CNBC CFO Council survey. This is our exclusive read on the thinking of corporate financial decision makers. So nearly half of our global CFOs, they believe we are on the path for a soft landing with the U.S. avoiding recession while keeping inflation under control. The roughly other half of respondents, they had kind of mixed views, with 15% forecasting a recession this year, another 15% saying that recession's already happened. So this is the highest read on soft landing confidence in the past 5 quarters. In Q1 of 2023, only about 1 out of 6 CFOs believe we were on the path for that soft landing. So it's this increase of confidence that CFOs giving the Fed high marks on its inflation battle. 22% say the central bank is doing an excellent job. 56% say a good job. Important to note, this is also the first time in 5 quarters there were no CFOs that gave the Fed a poor grade. In Q1 of 2023, 17% answered poor. So this survey was taken between February the 26th and March the 7th. During that time, we saw earnings come in 10% higher year over year, a PCE report, and Jay Powell testify on Capitol Hill, saying in part that rate cuts are coming. With that information, these financial decision makers have also have rate cut expectations that are largely in line with the market, forecasting a cut between June and September. Important to note, no CFO forecasted a cut in the March or the May meeting, but 7.5% did see a scenario where the Fed would not cut until 2025. We also got the CFO perspective on getting inflation down to the Fed's goal of 2%. About a quarter say it'll happen this year, but the overwhelming majority say this inflation fight will take until 2025 or possibly even longer.
Nice, that all sounds pretty bullish to me, and I guess that since those CFOs talked about the Dow, then at least some smart financial people still use it as a gauge of the market. Heck, I know that whenever I call my dad, he often asks me how the Dow is doing. I've told him that the SP 500 is a better gauge, but the Dow is still pretty popular. I get it though, and I'll sometimes talk about the Dow index for various reasons myself. Okay, let's take a look at the dogs of the Dow using one of my favorite stock tools, which is Fastgraphs, as it's an excellent way to quickly and visually see the value of a business relative to its stock price, amongst other things. I've previously just shown you some of what the basic Fastgraph subscription has, but now I'll show you some of what the premium subscription has. Like, one of the cool things you can do with premium has to do with pre-built portfolios of tickers that Fastgraphs maintains. So while on premium, you click on portfolios and then on preset portfolios. There you'll see a bunch of different useful portfolios, each one holding anywhere from 30 to almost 2,000 tickers. The first portfolio is called ADR, which stands for American Depository Receipt, which are tickers for international stocks. The second pre-built portfolio is the one we're looking for in this video, and which is called DJIA 30, which stands for Dow Jones Industrial Average 30, because there are 30 tickers in that index. Fastgraphs also has pre-built portfolios of all the dividend champions, which are the 148 tickers that have increased their dividends for 25 or more consecutive years, but aren't necessarily on the SP 500 like the classic dividend aristocrats are. They also have portfolios of dividend challengers, dividend contenders, portfolios of all the REITs that exist or all the REITs in Canada, etc. Okay, let's take a look at the Dow Jones tickers. So we see that Apple, Intel, Amazon, Microsoft, Verizon, etc. are all on the list, so mostly dividend stocks along with a few non-dividend stocks. Now, to identify which stocks in this list are the highest yielders, let's use a cool tool they have called Create View, which lets you view certain metrics and such. You can see they have tons of things you can input like year-to-date stock price returns, debt to capital, etc. And let's just select dividend yield for now, and I'll name this Dividend View, and I'll click on the new dividend yield column so we can sort by that. Now we can see what the highest yielding dividend stocks in the Dow are, with the top 10 being the Dividend Dogs. Number 1 is Verizon at 6.6% yield, then 3M at 6.4%, then Dow the chemical company at 4.88%, then Chevron, IBM, Amzn, Coca-Cola, Cisco, J&J, and Goldman Sachs. I'm currently long 4 of those 10 tickers, so I'd argue that they're decent companies overall, though the highest yielders are that way because they're facing various challenges. Like Verizon has some debt issues combined with some low growth concerns. 3M has a bunch of litigation concerns with PFASs and earplugs and such. Okay, let's click on Verizon and see what Fastgraph says about it. Right away, what jumps out at me in this graph is how cheap it looks. I mean, the black price line is way under both its average trended PE line, and it's way under the orange line, which represents the classic 50 PE trend line for many stocks. The reason why I like this valuation approach is because in my experience, price follows earnings. I like to think of earnings as gravity, with stock prices getting pulled towards earnings, though buying and selling pressures can make a stock's price break free from gravity in the short term. Okay, now let's look at another dividend dog in Coca-Cola, which I'm long in. Here we see the black price line is currently above both the blue trend line and the orange line, meaning it's a bit expensive. The bigger the margin of safety you want, then the lower the black line relative to the other lines you want to see. So being a dividend dog doesn't automatically mean it's cheap, though I bet statistically it often is cheap, and tools like Fastgraphs can help you determine that easier. All that got me thinking that an interesting variant strategy to dogs of the Dow might be to invest in the top 10 yielding cheap Dow stocks. I might need to backtest that and see how it goes. Or another variation on the dog strategy is called small dogs of the Dow, and it's where you buy the 5 lowest priced of the 10 highest yielding Dow stocks. According to one site I reviewed, the small dogs of the Dow strategy has historically outperformed the broader market by an average of 2% per year over the past 2 decades. So that might be something to dig into. And for my international investors, I read that the Dogs of the Dow method has been studied internationally and adapted to many foreign markets. Research shows over long periods, the DOGS method tends to result in superior risk-adjusted performance relative to market averages. However, the method also resulted in more volatility and short-term underperformance. Side note, I personally wouldn't want to invest in a company just because it's cheap, as I also need to feel confident in a company's ability to continue to pay dividends and such. Anyway, let's look at a non-dividend stock in the Dow Jones Index, and specifically Amazon. Here we see that its current price looks cheap relative to its historical PEs, but it's expensive compared to the 15 average PE. To the right of its current black line price are future estimates of Amazon's growth, which, if accurate, shows Amazon will keep growing quickly, and thus its price may also trend up. Of course, it's just an estimate, which could be wrong, and you always need to dig deeper to understand things like its financial trends, the competitive landscape, etc. Another cool feature of premium fast graphs is called fiscal fitness. Like, take a look at J&J's fitness, and I'm long J&J. So there's a ton of valuable information Fastgraph supplies here, but let's just look at the first one, which is free cash flow to dividends. The green bars are J&J's free cash flow to equity per share, and the purple bars are dividends paid out. Free cash flow to equity is the amount of cash a business generates that is available to be potentially distributed to shareholders. Dividends per share refers to the total dividend a company pays out over a 12-month period, divided by the total number of outstanding shares. From all this, I conclude that cash flow is trending up and dividends are trending up, and J&J has ample cash flow beyond anything the dividend uses, so this means it should have a lot of room for continuing to raise their dividend. As a comparison, let's look at Outro's free cash flow to dividends, even though Outtro isn't in the Dow, and note I'm long MO. Here we see that MO's free cash flow is only a tad over its dividend, which normally would freak me out a bit. But I know that since 2010, Outro's management has targeted a roughly 80% payout ratio of earnings to dividends because they have such a good handle on their stable business, so that helps me not to be worried about what I see. If you want to see an amazing free cash flow to dividends, then look at another Dow Jones ticker in Apple, which I'm also long in. Nice. Apple has crazy amounts of free cash flow relative to its dividend payout, which means they could easily pay a ton more in divvies if they wanted to, though they've been choosing to use their cash to do massive buybacks more so than focus on the divvy. And speaking of buybacks, let's click on the buyback fitness chart they have. Visually, you can tell that until 2012, Apple's share count was increasing, diluting shareholders, and then around when Tim Cook took over, he started driving material cash into buying back shares and decreasing outstanding shares. Thus, we see outstanding shares trending down. So like in 2012, they had about 26.5 billion shares outstanding, and recently they were at 15.8 billion. That's honestly astonishing to go from 26 billion shares to 16 billion in about a decade. That almost doubles the amount of Apple that each remaining share would be worth. And that's why I love buybacks and dividends, not just one or the other. Anyway, let me dive a bit more into the specifics of how you can create your own Dividend Dogs portfolio in your brokerage. What you do is in the beginning of each year, you look at how much you currently have invested in stocks, along with any cash you additionally want to invest. You then take that total amount and divide it by 10, which is the amount you would invest or allocate to whatever the 10 highest dividend yielding stocks were in the Dow Jones at that time. That would mean that you would sell out of any tickers that aren't in the new top 10 and reallocate capital accordingly. Throughout the years your dividends come in, you just pool that cash, ideally in a high interest account, and then you'd use that dividend cash at your annual rebalancing. All of that leads to an obvious downside to the strategy, which is that if you're doing this in a taxable account, then there could be some capital gains and loss implications. Though if you're holding tickers for over a year, then at least it should not be quite as bad as trades that were held for under a year. Remember, long-term capital gains tax is a tax on profits from the sale of an asset held for more than a year, whereas a short-term capital gain is a tax on profits from the sale of an asset held for a year or less. Generally speaking, short-term capital gain taxes range from 0% to 37%, and long-term capital taxes range from 0% to 20%. High-income earners may be subject to an additional 3.8% tax called the net investment income tax on both short and long-term capital gains. Or of course you could just do this in a retirement account and most likely not worry about the tax stuff. Overall, I think the Dogs strategy is interesting, but I still prefer what I'm doing. Please leave me a comment telling me what you think. I feel that the Dogs of the Dow tend to be great companies, ones that are often depressed, but that doesn't always mean they're always cheap, nor does it mean you would necessarily want to own them if you understood all the risks they face. One nice thing about the Dogs strategy is that it requires minimal effort to manage your portfolio. I mean, in theory, you would just rebalance your portfolio once a year and that's it. I looked around for an ETF that was doing the Dogs strategy, and I couldn't find any that did it exactly, but I did find one that is in the ballpark called the Invesco Dow Jones Industrial Average Dividend ETF, ticker DJD, which has a nice low expense ratio. It looks like it slightly underperformed the Dow Jones Index, thus slightly lower total returns, but has given you a higher income stream. And then I found an ETF called ALPS Sector Dividend Dogs ETF, ticker SDOG, which has a higher expense ratio and which finds tickers that give it equal weight exposure to the 5 highest yielding stocks in 10 sectors across the 500 largest companies in the US. And it looks like SDOG has underperformed over time from a total returns perspective, but I could see reasons why you might choose to go with it. Whatever you do, at least try to be consistent with your investing, especially over long periods of time, as that's honestly the easiest way to win. And like I've previously said, investing is kind of like working out. I mean, you can hit the gym, but if you look in the mirror, you won't see much difference early on. But if you hit the gym every day for months and years, then you should definitely see the results. So you might only be investing $25 a week right now, and your overall portfolio might look weak. But invest non-stupidly for decades, and you'll be impressed by how far your portfolio goes. And regardless, don't be discouraged if you're behind the 8 ball saving for retirement, because at least you're spending time learning more about financial education, and I'm confident that will really help you out over the long run. The reality is that most folks aren't where they want to be with their retirement portfolios. In fact, the Schroders 2023 U.S. Retirement Survey showed that the median amount of retirement savings for Gen X households was just $40,000. Let me show you some comments on a recent retirement article I just read that highlights some challenges people face. Like this first one was from a 59-year-old who said that he had a pension at his first job, but they ended up doing away with their pension and offered a voluntary 401k instead. This guy didn't really understand 401ks or how useful they could be, so he didn't start investing in one until years later when he was at a different job where they really made him understand how important they are. Or look at this comment from a 47-year-old who said he has nothing to his name other than a small 401k, and he unfortunately has $10K of credit card debt, which he only pays the minimum against each month. The dude said he makes $130,000 a year, but he blows all his money so he can enjoy his life in the present. He doesn't own a house, and he figures he'll work until he dies, and he said both his grandparents had nothing other than Social Security in retirement, and if they could get by that way, then he could as well. Unfortunately, he's probably not aware that Social Security benefits will probably be cut by about 25% of what they should be, unless something materially changes with Social Security. The guy said he plans to live with his kids when he's old and unable to work. My point in sharing those comments is that while you might not have built your portfolio to where you want it to be, I bet your ongoing efforts you're putting into learning, combined with whatever you're driving into your portfolio, will enable a retirement that is way better than most folks in the world. So don't stress and just keep doing your best and don't make too many dumb decisions. And with that, I'd like to close things up, and I'll ask you to consider using my Fastgraphs affiliate link with my coupon code in the description of this video, because doing that allows new users to get 25% off their first payment, even if you sign up for a full year all at once. Also consider using my Seeking Alpha affiliate link, which often comes with benefits for new member signups. Finally, consider joining my Patreon, or if that doesn't have any seats available, then join my channel as a member, as doing that has a variety of cool perks that come with it, such as badges by your comments on my videos, along with the ability to watch my videos before I release them publicly, as well as my members get to vote on which thumbnails I use, not to mention the shoutouts I do. And with that, I'd ask you to kindly hit the thumbs up button, subscribe if you haven't yet, and click that bell notification. Finally, please join my free Dividend Discord chat server, which has over 11,000 dividend investors on it from 80 countries around the world. Thanks for watching, stay positive, and I'll talk to you again real soon. Remember, I'm not a financial advisor, and my videos are for entertainment and inspirational purposes only. Investing of any kind involves risk. I'm only sharing my opinions with no guarantee of gains or losses on investments.